Looks like we might have everyone in now. Hi everyone. Welcome to the Optimised webinar, Hedging Your Bets on Green Gas. Just want to say a huge thank you to ADBA, who are obviously hosting this event. We've had close links with ADBA since going back to 2017. Particular highlights tend to be the Expo every year, so fingers crossed I'll see a lot of you in about 6 months' time anyway. Just as a polite notice, we are recording this webinar, so thereafter we will be sharing the link so you can share with colleagues, different contacts that you've got out there in the industry. If possible, it'd be great if we could try and leave the questions till the end. We want to try and get through as much content as we can within the next hour, which will hopefully utilize your lunchtime to its optimum. So let's get started. So first off, I just wanted to give you a bit of information about Optimised, who we are. We started out in 2002, and we've now grown to a business which we have over 130 employees. We specialise in the energy markets and risk management services. This is for both generators and off-takers. What makes us quite unique is I'd say around about a quarter of our clients are actually generators that export to the grid. So kind of go into the topics, what we're going to be discussing today, the reason for today's webinar, and it's primarily to sort of address some of the challenges that we know AD is facing at this moment in time. So our initial focus is going to be on energy markets, where we've seen huge upside for generators in the last couple of years. But with conversations I've had out there in the industry, not all generators have necessarily been able to sort of monetize that successfully, given some of the other challenges we face. So we're hoping to bring sort of our learnings from our trading and risk management team to support AD plants with solidifying future revenues. As we know, unlike wind and solar, etc., the cost base has massively increased, as well as the energy markets. Secondly, we're going to sort of have a look at the green gas certificates, as we are seeing an increase in demand for these. Corporate net zero ambitions have kind of buoyed the certificate price, as well as we've seen over the last sort of year or two, just this steady rise and increase. The issue we've got is green gas certificates do face more scrutiny than RGGOs. And World Research Institute could be scuppering plans, but that's pending the outcome of the market-based emissions framework. Thereafter, we're going to touch on the growth of hydrogen. What is hydrogen? Is it real? And how is it going to impact the green gas market? And then finally, we've got Ewan from Iona Capital, who we're talking more about the challenges AD plants currently face in balancing operational and market pricing risk. So a huge thank you to Ewan for supporting this webinar also. So without further ado, I'll hand you over to Dave, who is our head of trading and risk management, and he's going to discuss markets and hedging strategies. Thanks, Dave.
Cheers for that, Lewis. So we'll just start with a quick overview as to kind of the market, how that's developed over the past sort of 18 to 24 months, which has sort of led to the position that we're in right now. So if you take a look at the graph on the screen at the minute, this is looking at April 23 annuals, which is an average of the summer 23 and winter 23 season, so those forward-looking contracts. And you can pretty much see there the exponential rise in prices that we've seen through from 2021 through to sort of Q3 of 2022, whereby we suddenly see that retracement in price. Now, a lot of this upside sort of stemmed off the back of COVID. Obviously, COVID, we saw sort of multi-year market lows in terms of price, with that demand reduction decreasing significantly. As we came through to 2021, there was very much the leading story there was around the lack of gas storage that we had across Europe. A lot of that being off the back of sort of delayed maintenance from 2020 occurring through 2021, meaning a reduction in that supply level, but also an increase in demand off the back of that COVID recovery as well. So that kind of started stemming the issue that we saw here, or the sort of higher prices that we saw throughout 2021. As we came into 2022, that sort of issue was exacerbated. that sort of supply-demand balance further exaggerated, particularly when we got past sort of March, the Russia-Ukraine war kicked off, and it was really a move from EU to move away from Russian gas independence. So that supply was really taking a hit. Now, back in sort of 2021 and prior to that Russia-Ukraine war kicking off, we were about 40% reliant on Russia for our gas across Europe. Fast forward to where we are now, 2022, we've now got less than 5% of European gas being sourced from Russia. As we've moved away from that, we still have some flowing through that Ukrainian pipeline, and we are now sort of 40% reliant on LNG, liquefied natural gas, so a global market. This time last year, that was only about 15% reliance on LNG markets. So although we've alleviated that imminent issue of the Russian gas dependency, we've kind of shifted that issue, which brings us into a more volatile market space. Now, the key point on this graph is probably sort of everything post July 2022, and that's when you can really see market prices really rallying at quite a rapid pace. That was a number of factors that fed into that, a number of fundamentals. You had the fire at the Freeport LNG facility in the US. That's responsible for about 20% of US exports of LNG. On top of that, we had reduced flows along those Russian pipelines. So Nord Stream 1 was reducing capacity. They had a 10-day outage periods for maintenance. That returned to 40% capacity, and then it came down to 20% capacity. And then just to add to that further and exacerbate that upside, we saw the demand levels increasing as well. So Europe and the UK were subject to quite significant heat waves throughout the summer. You'll remember it hit 40 degrees in the UK, which is very abnormal. In which case we need more demand to support that aircon load, that increased demand level. But not only that, we saw an increased level of demand over in Northeast Asia as well. So Japan was subject to their worst heat wave since 1875. And as such, they turned to that global LNG market to try and source additional supply. So when you get a market, a global market like that, where it's very reliant on one supply asset, you end up with a bit of a price competition. And that's what we really saw throughout July and August. And that's what really drove those prices upwards. Reduction in supply, an increase in demand, really driving price up. Funnily enough, when you come into September, that was around the time that Nord Stream 1 went offline for a 3-day maintenance period, with concerns that that wouldn't come back online after that. Now, typically the expectation in the markets is that if you're expecting a large supply to go offline indefinitely, you would expect that to further exacerbate the upside price. So you would have expected that curve to continue into September. But what actually happened was when that pipeline went offline and it was confirmed to be offline indefinitely, we actually saw the market retrace somewhat. And that's pretty much that vertical line that you can see from September 22. Reason being is throughout 2022, all the risk that had been built into market prices on the basis that what if Russia turn off these taps and the impact that would have on the market, a lot of that risk was then eroded from the market because the pipeline went offline. Can't really get any worse than that, but that supply demand level was still relatively balanced. We had an abundance of LNG coming across to the UK and Europe, so the supply level was sufficient. And temperatures throughout that period were above seasonal norms. So the demand level was actually relatively subdued. And if you consider where we are right now, arguably in a bit of a bearish cycle or a bearish trend at the minute, but we're in the back end of October now. Temperatures are still sitting above seasonal norms, although they're expected to retrace down to seasonal norms over the coming weeks, which means that demand level is sort of staying relatively subdued and supply is staying pretty healthy still. So where we go from here is really a bit of a risk. We did a webinar a couple of weeks back on that winter outlook, and I think it's really going to come down to kind of how the weather outturns this year and the impact that will have on prices. But currently, with that looking relatively mild and relatively healthy from a supply perspective, we should expect to see a little bit more downside. Just pop onto the next slide, please, Lewis. Thank you. Just in terms of that market development over that period of time, now I've broken this down into the rolling day, month, quarter and seasonal prices. Now you can see throughout 2020, 2021, those markets were pretty well correlated, and the price at which you'd achieve for each of those different sort of trading contracts was relatively aligned up until you get into sort of summer 2022, and that's when we really start seeing a bit of a divergence between these markets. So if we just zoom into that kind of final stage of the graph, you can really see that sort of divergence between those markets, particularly when you start looking at the shorter term contracts, so your day ahead contracts and your month ahead contracts. Those are really seeing that downside a lot more than the sort of longer dated contracts. Your season is still holding a little bit of strength, forward seasons, on the basis that risk, the underlying risk, still resides around how we're going to supply the market over that time. But a lot of that imminent price risk is eroding out of the market in the short term. So that's why it's really important that when we're looking at gas to grid hedging strategies, we look at not only the short term and minimizing that sort of generation variability, but we look at also the price makeup as well and spreading our risk to maximize those revenues where we can. Hop on to the next slide, please, Liz. We're just going to go on to the next slide. Cheers. So when you're looking at hedging risks, there's really two main risks that you want to be considering. Now, the first one is around that price volatility and indeed the price as a whole. So again, what we've done here is we've looked at the day, month, quarter and seasonal markets, and then we've looked at the sort of rolling average of market volatility over the past 2 years or nearly 2 years, just to show you or demonstrate the level of volatility and the risk that is now posing. So back through 2020 and 2021, that level of volatility was increasing marginally, but it's still staying relatively controlled in the sort of variability month to month wouldn't really exceed that sort of 10 pence per therm mark. But as we fast forward through the back end of 2021 and certainly into 2022, you can really see that increase in volatility levels. And that's what really poses a risk when you're looking at market hedging strategies. Because variability in price, although it can be on the upside, which can be a benefit, that can also retrace at just as quick a rate. So you want to make sure that you are hedging in an appropriate manner to mitigate this risk to market volatility while still trying to maximize that price. Now, the other thing to just point out on here, where on the previous graph we were saying that shorter term prices are currently feeling more of the downside effect and actually sort of diverging more in terms of their sort of downside capability. What we're seeing on this side is sort of supporting that fact with the increased levels of volatility, or the higher levels of volatility are shown on those shorter term contracts as well. That day and month contracts show a lot more or a lot higher level of volatility than the seasonal market. So arguably the seasonal markets are the safer way of hedging, in the fact that you're taking a longer term view, you're spreading your risk, you're taking more of a proactive hedging strategy, and you're really reducing your risk to that market volatility. On the other side of the coin, when we're looking at other risks, the main one from an export perspective is when you're looking at consumption variability. Now, this is a key factor when you're looking at your hedging strategy, to make sure you're not exceeding any sort of generational level that you're expecting to produce, but also mitigating any risk to unplanned outages. So the big ones that you can see on this slide here are planned maintenance. Usually you should have an idea of when you're going to have scheduled maintenance, and ideally the longer or the more in advance you can sort of plan that into your trading strategy, the better. It allows you to have more time to react to markets, particularly longer term markets, and try and take advantage of any trading activity that needs to occur to manage that profile. The other one is the unexpected outages, and these are the real sort of risk factors when you're looking at gas to grid hedging strategies. The best or the most important thing when you have an unexpected outage is trying to establish that expected length of the outage, because that's critical to the reaction that you need to make through the trading strategy. If you're expected to just be on an outage for sort of a day, 2 days, the impact of that should be relatively minimal, and the actual reaction that you can do through trading is also relatively minimal. You're exposed to a very short-term market, and whether you trade or whether you stay exposed is going to be relatively similar in terms of the outcome. But if that unplanned outage is expected to run for a month or 2 months or even longer than that, you can at least take a little bit more of a proactive view to spread your risk a little bit more. The other 2 points I put on there is capacity factor. There's a common misconception that capacity factor is the profile by which people think they're going to generate. It's often the case that generators don't actually reach their capacity factor. So it's taking a view of what their actual likely generation is going to be and making sure you build your hedging strategy off the back of that. And then likely is the forecasting and trying to get the best view possible of how you expect your asset to perform and what level of generation you're expecting to be producing. It's important to review that on a regular basis to make sure that any trading strategy you have in place, any traded levels or hedge levels that you've got in place can be adapted if you think that your generation is going to fluctuate somewhat. Predominantly, if you're an AD plant, for example, you should have a relatively stable output, which makes it a lot easier in terms of hedging strategies. You can see there just highlighted just a few periods. That first one being a planned maintenance. It's quite clear that that was going off for a period of time and then back online. The other two that you can see there are more unexpected outages, where it's kind of gone offline in a relatively unexpected fashion. So when you start looking at building your hedging strategy, the first thing that you need to do is understand your risk appetite. And there's a quote there by a guy called Peter Bernstein that says the essence of risk management lies in maximizing the areas where we have some control over the outcome, whilst minimizing the areas where we have absolutely no control over the outcome. And I think that's extremely pertinent in this day and age. Anything that we have no control over is trying to minimize any risk there. But where we have real control is around that sort of forward hedging strategy, the strategy that we put in place first and foremost, but also the trades that we then make. That's the bit where we've got most control, and that's the bit where we should be really focusing on risk management strategy. Now, there's three main things that you should consider when looking at building your risk management strategy. First is understanding what is the most pertinent factor for you. Is that the revenue certainty? Is that ensuring that you sort of build your strategy to make a certain revenue? Is it overheads, making sure that you're covering the cost of your overheads to make sure that what you're doing is a profitable business? Or is it finally that you are sort of focusing on solely the unit price and really trying to maximize as much as you can? Typically what you'd expect is when you're going for the unit price and completely maximizing your achieved cost or achieved revenue, sorry, is that you've got to accept that that is typically a higher risk model and that it doesn't always perform. While some years you'll have extremely good years, good performing years, 2022 being one of those, you'll also accept that there are years such as 2020 where you may suffer sort of poorer prices as well. So it's trying to establish firstly where you sit on this sort of Venn diagram. A lot of people will say they want to sit right in the middle. They want to have the revenue certainty, they want to cover their overheads, and they want to hit the unit price as high as they can. That's a pretty difficult place to reach. It can be done in certain circumstances, but you really need to focus on what is the main priority of these three. And then that kind of goes into sort of building your actual risk strategy. Now, it goes without saying before we go into this slide that there's no one hat fits all. There's no one way of doing this. It's very much done on a bespoke basis. So what I would encourage following this call is that you get in touch with your account manager or get in touch with Lewis and really start sort of determining what is the priority for you. And then off the back of that, we can start establishing where your priorities lie and what an appropriate risk strategy may be. But when you look at strategy options, firstly, you can do nothing. You can effectively ride the spot market, see what happens. In 2022, you would have had a relatively good year, although you look at some of the short-term gas prices now, I think I saw it down at 40 pence per therm earlier today. And like I say, that volatility is really the risk that you're riding there. You're completely minimizing your consumption risk, but you're really sort of maximizing your price risk there. Secondly is looking at price-based strategy. So this is looking at taking a forward view on markets, slowly building up a position, but based on price triggers typically. So this would typically look to meet using effectively a floor for if you're trying to cover your overheads, or potentially a price cap if you're trying to hit a certain revenue. But that would be when the price hits a certain level, or if the price moves by X percentage, that warrants trading off the back of that. Now, in such a volatile market, I would say this is a relatively risky way of trading just because of that level of volatility. Caps and floors can be often triggered for only a short period of time. The price might hit that for 10 minutes and then come back down. by which you will have invoked the trading action off the back of that. So it's a relatively risky strategy in the current market space. Thirdly is looking at more of a volumetric based strategy. Now, this is a case of building up a position over a period of time to spread your risk and taking more of a forward view of the market. Now, whilst this mitigates your price risk considerably, and that risk to the volatility within the markets, what this is really sort of imposing the risk on more is those unexpected outages. If you're building a long-term sort of forward position, you can account for any planned maintenance, providing you have a long enough lead time to that downtime. But it's really the unexpected outage period which is going to be the concern here. So it's definitely worth considering when you're looking at this to build an upper level on how much you want to hedge. Obviously, you don't want to look to try and hedge 100% of your volume, because that poses quite a risk if you do have an unexpected outage. But what you want to do is establish a level that you feel comfortable with, that should you have some downtime, how much of your facility would you expect to be down at any one time, and trying to account for that within this sort of forward volumetric based strategy. And then finally, you would kind of bring together the sort of points 2 and 3 there, and look to bring in a price and volume based strategy. So when the market hits a certain level or is moved by a certain percentage, that invokes a trade of X percentage. So you're slowly building up your position over a period of time and spreading your risk. Those are typically some of the ways that you can start looking at building up a strategy. But like I say, it's very much a bespoke basis. So I really recommend getting in touch with us and really sort of first determining your risk appetite and what your priorities are, and then building something bespoke off the back of that.
Thanks, Dave. Greatly appreciated. So next up, we're going to move on to sort of green gas certificates and some of the issues that we're facing at the moment. So I'll introduce you to Helena now. Hi, Helena.
Hiya. Thanks, Lewis. Yeah, as you've said, I'm going to be talking about green gas certificates, specifically about the update to the Greenhouse Gas Protocol guidance. And I think to best understand that update, we need to have a little look at the background around the Greenhouse Gas Protocol and emission reporting. So the Greenhouse Gas Protocol was developed in 1998 by the World Resources Institute and the World Business Council for Sustainable Development. And it's a standardized framework for greenhouse gas emissions measurement and reporting. And it's the most widely recognized standard for carbon reporting. And it splits an organization's emissions into 3 scopes. So that's scope 1, scope 2, and scope 3. So you have your scope 1 emissions, which are your direct emissions. So that will be from the combustion of gas on site, for example, in boilers, generators, and your fleet of vehicles. Then you have scope 2, indirect emissions from purchased electricity. And finally, you have scope 3, and those are other indirect emissions that aren't included in scope 2. So those might be categories like purchased goods and services, waste generated in operations, and business travel. And historically, scope 1 and 2 emissions were reported using both market-based and location-based methods, and that's known as dual reporting. So a location-based method is focused on where you are, and it reflects the average emissions intensity of that grid using an average grid emission factor. And then you have the market-based method, which reflects the electricity that you've actually chosen. So that might be through contractual instruments such as green gas certificates, direct contracts, and supplier-specific emission rates. And over the years, there's been some uncertainty about the reporting of scope 1 emissions. So between 2015 and 2019, there was an annex in the scope 2 guidance put forward by the Greenhouse Gas Protocol. And in that guidance, they said that scope 1 emissions could be reported in the same way as scope 2 emissions using the dual reporting method. But in 2019, that annex was removed, which sparked a lot of uncertainty about whether or not that approach was valid for scope 1 emissions. And since then, in 2021, they've released some draft guidance, which suggested that they might be removing the market-based method for scope 1 emissions. And we've had further guidance this year, which is suggesting that from next year, that that approach might be removed for Scope 1 emissions. So what does that mean? It would mean that guarantees of origin and renewable electricity certificates would no longer be valid to account for emission reductions in greenhouse gas inventories for Scope 1. And that's an issue because currently, if organizations are using those contractual instruments to report carbon reductions in their Scope 1, they would no longer be able to do that, and any kind of avoided emissions would have to be reported off scope. And that might well remove the incentive for organizations to invest in green certificates. And that will have a knock-on effect on the speed of decarbonisation of the UK grid, of the pricing of green gas certificates and green investment in general. And we might even see that green gas certificates, if that were to happen, would be treated more like avoidance offsets. And I'll get into what that means in a minute. So you might be thinking, why Scope 1 emissions? Why are they being treated differently to Scope 2 emissions when the contractual instruments and mechanisms are so similar? But that argument was put forward to the Greenhouse Gas Protocol, and they responded by stating that they plan to examine the appropriateness of market-based accounting across all scopes, so not just Scope 1. Whether or not that means that market-based accounting will be permitted for Scope 2 remains unclear. It's already very embedded in the system, so we can assume it probably will continue. But what that means for Scope 1 and Scope 3 is unclear. And they are addressing market-based accounting due to the current claims of greenwashing due to the lack of additionality. So the issue is that some organizations are purchasing certificates from government-supported generators, and they're then reporting carbon savings from the displacement of fossil fuels. But actually, those certificates don't deliver any additional environmental benefit. So what they're planning to do is remove the market-based approach for Scope 1 to address those greenwashing claims, when really the issue here isn't the contractual mechanism, it's the lack of additionality. So going back to my point on offsetting, this is a flowchart that came from the Oxford Principles of Net Zero Aligned Offsetting. And as you can see, carbon offsets can be broadly broken down into two sort of categories: emission reductions and carbon removals. And it's widely considered that best practice in terms of offsetting on your way to net zero is to move from the left-hand side of this chart to the right towards carbon removals at the net zero target date. And because of this, carbon removals are much more expensive and much more desirable, quite difficult to get your hands on. Whereas on the left-hand side of the chart, these avoided emissions or emission reduction credits are much cheaper and much more accessible. If the guidance were to be finalised and the market-based approach were not to be valid for Scope 1 emissions, the green gas certificates would be treated as avoidance credits because they wouldn't be counted for emission reductions within your greenhouse gas inventory. But they could still be used for offsetting. And as they would fall into this category on the left-hand side, they wouldn't be treated with the value that we believe that they do have, as green gas certificates are essential for decarbonising the UK gas grid. And at the moment, they're the only really accessible way for most organisations to reduce their Scope 1 emissions, especially smaller organisations without the resources to implement, engineered strategies. So our thoughts at Optimised, we believe that the WRI should not conflate the issue of additionality and the delivery mechanism of contractual instruments. We believe that it's not the market-based approach that is the issue itself. It's the fact that people are currently allowed to buy these certificates that lack additionality. So tighter criteria is needed in order to ensure that additionality is delivered. The proposed changes might well remove the organisation's incentive to purchase green gas certificates, as they can't report those savings in scope. And that may negatively impact the biomethane market, though that's still unclear, as they might still be treated as valuable as offsets, and people might still see the value in decarbonising the grid at speed, which would lower location-based Scope 1 emissions also. We believe that green gas is essential for that fast-paced decarbonisation, and that if we slow the green investment, it's going to impede our ability to remain below 1.5 degrees of warming and to meet the Paris Agreement targets. So at the moment, there's an ongoing consultation with the Greenhouse Gas Protocol, which we're a part of. And as you can see from the timeline, it's currently in a review process and pilot testing process, where they've published their draft guidance, and several different organisations are giving their feedback. So we're hoping that they will take those thoughts on board. But next year, in 2023, we'll hopefully see the finalised standard. And until then, there's going to be a continued period of uncertainty. So we've got some ongoing questions that are still quite unclear. What will happen to market-based reporting? As I've mentioned, unclear. It's being assessed across all scopes, so that's something that we'll have to watch out for. How will voluntary carbon reporting frameworks respond? So typically, frameworks like the Science-Based Target Initiative and CDP tend to align with the Greenhouse Gas Protocol, as it's the most widely recognised carbon accounting standard. So we can expect to see the same once they have finalised their guidance next year. But until then, I don't think we'll see any changes in the short term. So what should organisations do in the meantime? Again, we're not going to know what the changes are until next year. So I think we just need to be aware of the changes that might take place and be prepared for that. And also bear in mind that if market-based reporting is removed for Scope 1, that might well trigger a recalculation of your base year. And how will this affect the price of green gas certificates? Again, an unknown. As Lewis mentioned before, we've seen an increase in demand over the past couple of years, which has led to an increased price. Whether or not market-based reporting is permitted with the new guidance will have an impact on pricing, but until that time, we can't predict what direction it will go. Thank you.
Thanks, Eleanor. So next I'm introducing Magnus. So he's going to touch on a few points around hydrogen and how that's going to potentially impact green gas going forward. Thanks, Magnus.
Cheers, Lewis. Right. So if you move on to the first slide, please, Lewis. I am going to just talk through the current status of what's going on in the hydrogen side of things, and in particular the government initiatives that are backing projects, what might come along in terms of projects, what is going on in the grid side of things, and some thoughts as to when they're going to start impacting elsewhere. So hydrogen is really being pushed by the government. It's been for the last couple of years one of their major themes in energy. They see it as being a core part of the drive towards net zero, and even a couple of years ago, when that roadmap on the right hand side was put out, they started doling out money. So £10 million has already been given to a couple of big projects, one of which I'll look at in a short period of time. But the major piece of sort of roadmap and guidance that's been put out came out in April this year, and that is laying out exactly what the government is going to be prepared to invest in over the next few years, and what they see as being their target. So they're aiming for 5 gigawatts of hydrogen production by the end of the decade. They're prepared to put in the money They're prepared to work with the industry to create a framework which lays out the minimum standards required, and they are going to be ensuring that there is support from BEIS to do this. They see, as they put out in their report, that it's critical for hydrogen to be working industry that is going to be producing green hydrogen by 2030, 2040. So if we move on to the next slide, which shows the roadmap, you can see it's quite an ambitious set of targets that they've put out. I don't propose to go through all of these in great detail, but I think what you should pick up from this, particularly in the next 2 or 3 years, is the support, financial support that they have put out there through this initiative to companies in order to access funds to put in place projects and keep the UK at the forefront of hydrogen development. In particular, they are looking to ensure that it's not just one form of hydrogen production. So if we move on to the next slide, start looking at a couple of the kind of big projects that are out there. So HyNet, based in Cheshire, covering Merseyside and into Lancashire, is one of those major projects. It's already received £7.5 million, and it's predominantly looking at carbon capture, creating a grid, working with industrial partners in Cheshire and the Northwest. And I think that's key. This is something that is seen outside part of the gas grid for the time being. Then if you move on to the Teesside, this is going to be produced from gas, so a blue hydrogen facility. This is a £100 million project, but as I put there, nothing is certain on this. This is looking again at getting government investments into it, and it's going to produce hydrogen for filling for large vehicles. So they expect to be able to produce 30% of the government's 5 gigawatt hydrogen production by 2030, and that in turn would then feed 13,000 trucks, large trucks. The third one is a dedicated green project, but just like the others, it is at very early stages. It is still getting planning permission. It's still looking to get going, and it's not certain that it will happen. The last one, proposal for a large carbon capture and usage storage with a hydrogen production, and that is going to be a more long-term project as well. So similarly, it's going to be looking for getting money from the government over the next couple of years. So in essence, lots of projects out there, lots of government support, but nothing absolutely certain on what's going to happen on these projects in terms of their viability at this point in time. And if we move on to the next slide, please. So what's happening actually on the grid side of things? It's been a case of building up from a very small private grid trial at Kiel. And then there's been a small trial that's ran for 10 months in the Northeast. The biggest kind of trial that's going to be happening could potentially be happening within this HyNet region on the Wirral. What they're going to do is they're going to use the whole of the grid in a locality, create this hydrogen village, and they are going to take all the hydrogen, all the gas boilers that are in the area and change them all to hydrogen specific boilers. That should be announced in the next couple of months. I think there's a very good chance it's going to be on the Wirral, and it would actually help in terms of the feasibility of the HyNet project. Now, if that HyNet project does take off and all those industrial partners that they have do convert entirely to hydrogen, then they could look to expand that network. But we're talking end of the decade into the early 2030s. Move on. Okay, so just a kind of summary and some thoughts. The government is really behind this hydrogen in terms of it going to be a key part of their decarbonisation. But I really cannot see that we're going to have anything happening particularly soon. We're going to have more blue hydrogen created, but I don't think, given the cost differentials between blue hydrogen and green hydrogen, with blue hydrogen cheaper than green hydrogen by even 50% at the moment, that we're going to be in a position where either there's going to be sizable green hydrogen production, or that it's going to get into the grid at any size, and even if they do start injecting green hydrogen into the grid or blue hydrogen into the grid, at the moment they're still restricted to 20% of the volume. When you talk about green hydrogen, I think we've got to differentiate between the excess wind and solar that would be created on green hydrogen and coming into the system. Given the state of the power market and the gas prices at the moment, I think I don't think there really is that much excess wind and solar that is going to make a big difference. If we get to 40 gigs of offshore generation by the end of the decade, which is the government's plan, then we could start to think about seeing potential for excess green hydrogen production. But it all depends on the cost, the trading reforms that are being proposed on the electricity market, whether those work together to support it. So in my mind, at the present time, I don't think there's any kind of competitive side from hydrogen to green gas. I think it's very much a localized thing. I think some of those projects that are being talked about may come to fruition, but they're not going to be making a huge difference for the time being. Thank you.
Thanks, Magnus. So next off, I'm going to move on to Ewan from Iona Capital. Just want to thank you again for joining this webinar and sharing your thoughts with everything that's going on at the moment. So cheers for that, Ewan. Over to you.
No problem at all, Lewis. Thanks a lot. And I'd like to extend my thanks to James and the Optimised team for giving me the opportunity to talk to you all today, actually. And it's really good to have this opportunity. What I'm hoping to do is I'm just going to talk through, give you a little bit about Iona Capital, and also talk through sort of the characteristics of our investment portfolio, our future pipeline, which is traditionally AD plants and is also moving forwards into other technologies, and how that interfaces with the current energy market conditions, how that's changed, and some of the risks and the effects that we really need to be aware of. And I really commend, I think, for complete sort of transparency, we do work with Optimised across our gas hedging elements of it. We don't particularly work with Optimised regarding green gas certificates, although there is definitely some opportunity to do that in the future. And I will talk a bit about green gas certificates and green gas pricing as we go on. Next slide, please, Liz. So Iona Capital is a renewable investor. We've been operating in what we call infrastructure, environmental infrastructure, since 2011. So that includes waste management technologies. How this plays down mostly at the moment is an existing extant portfolio of anaerobic digestion assets, both electrical and biomethane, and a pipeline of energy from waste investments. I think the thing that it's really worth bringing out here as we start this off, sort of linking back to what about with how you balance your risk is actually the majority of AD plants in this country will have been built using institutional money, and it sits within the low risk box in their particular risk matrix. Well, which is absolutely great, but we do therefore need to always bear that in mind when we're thinking about how we go about maximising our revenue streams, etc. So you have all those government index-linked subsidies, which is what makes it really, really low risk in the eyes of institutional investors. But then actually, you've then got the issue of the fact that I put in there base load in inverted commas. Well, some AD plants are incredibly reliable, but I think probably looking across our portfolio, there are a number of them which are less reliable. So it probably sits, but it doesn't feel it's quite a difficult box for it to sit in. It's not intermittent like wind and solar, but at the same time, it's not like an energy from waste plant, which will run largely like a Swiss watch for 8,000 hours. So that really needs to be taken into consideration. I think it's also really worth bringing to the point the fact that the world sort of really did change in 2020. And I think I've said that 2021, but actually 2020 was probably the point where things really started to shift, both negatively and positively. Prior to that, I would have characterized, and I think our investors would have characterized, the power and gas sales really as the cream on the top of the financial base case. I think after 2020, the importance of maximizing revenues from those power and gas sales has become much more important, particularly with those complex feedstock economics, which I'll talk about a little bit, but not a great deal later on. When you compare that to an energy from waste pipeline, they operate at much greater scale. Sort of 7 mega electrical is probably about the smallest you would get, providing genuine baseload power provision. I think at the height of the lockdown during 2020, something like 10% of the UK grid was at basically the Veolia EFW fleet. So increasingly, it's something that could become much more important as intermittent renewables or variable deliverability renewables become more and more prevalent on the grid. It's also worth bearing in mind that there's a biogenic element to the feedstock of an energy from waste plant, which it does generate RGGOs. And I think that's something I'll touch on later, which is worth sort of as bearing in mind as well. It's always worth bearing in mind with energy from waste projects. Slide, please, Lewis. Oh, sorry, go back.
There we go.
So I just want to talk very briefly about how that market has changed, how the energy market has changed. And the graphs I've got up here are essentially, you can argue the toss about whether they're worth the paper they're written on, but we need something to value our funds off. And these are our house forward gas and power curves. One of them, I mean, we don't put them together, and an external consultancy does them for us. The top one's the power, the bottom one's the gas, and you can see what the price was in pound per megawatt hour predicted out to the end of 2025, as it was done in August 2020, and then also at August 2022. And you can see that there's been a significant movement in the two, and this causes, taking back to that point about low risk and the institutional investors who've backed a lot of these projects, is that you've got a significant issue there, which is that you're valuing the asset based on these curves, but then there's actually a significant difference between that and how the market's going to turn out. Be that a positive thing, where I believe the pricing, certainly forward pricing, got up towards 800 pence a therm for winter 22-23 in August. And that sentiment would definitely have impacted on these valuation curves. But then you also have the fact that the market, as Dave alluded to, the gas market's currently oversupplied, and the gas price is quite a bit lower than that, that you're basing your valuations from. So I think it's worth bringing out the point that the current high energy prices are not necessarily the nice problem to have, which it is for, if you just happen to be, if you're commissioning, for example, an EFW plant is on a 100% spill contract, it's probably doing all right. But across the sector where you do need to de-risk yourself, and you've got a real tightrope to walk there between what the long-term outlook may or may not be and how that's moved over the last few years, and also how things are actually turning out now. You then layer on top of that the regulatory uncertainty around the power market, and which is essentially making it very difficult to get further fixed price power purchase agreements in the market at the moment, because there's just so little going on. There's just so much regulatory uncertainty there, which and then you factor on top of that when a power purchase off taker looks at your 12 months or 24 months of half hourly export data, it doesn't look like a solar farm. It doesn't look like a natural gas generation asset, and they start to really worry about things like credit cover and stuff like that. So looking out, sort of pricing out 24, 25 is looking increasingly difficult. Slide, please, Liz. So I think, and it's worth touching here, that on the fact that we've worked quite closely with Optimised in this area, that there's a potential solution here for both power and gas, but we'll focus on the gas, which is some sort of corporate offtake. And we're very fortunate. We're in a position with which we have a corporate offtaker with a major real estate, with a major London real estate entity, which essentially provides a gas price, and we also provide the green gas certificates to them. And it provides what really is, as other speakers have touched on, is the fact that green gas at the moment does provide, it is the main way, actual low carbon, short chain carbon means of decarbonising heat provision, and to a degree power provision, that is available in the market right now for people with a high heat demand. So the way this originally came about was as a contract for difference, much like the contracts for difference that you might get from the low carbon contracts company, whereby a strike price would be agreed, and between the off-taker and the gas producer, and then you need an honest broker, which is in our case is Optimised, who does the settlement work for it and decides who pays who as time goes on. The great thing about this is it creates a meaningful commercial linkage between the gas producer and the gas user, which means that when you provide those certificates, that using a mass balance approach, you can say, you can absolutely say, this is not greenwashing. The molecules that are burnt in my CHP are absolutely balanced off by molecules injected into the gas grid at an AD plant in, for example, Scotland. And on a mass balance approach, we can prove that we are burning short chain carbon, that we're releasing rather short chain carbon that was in the atmosphere this time last summer, as opposed to that's come out the Permian Basin somewhere from millions of years ago. I think and I've put disadvantages on here. Disadvantages is really the wrong term. It's just sort of considerations to have with this, as I thoroughly recommend it. As much as if that is what you're looking for, to balance the risk from your AD plant within your portfolio. But you have to work out that you have to be absolutely clear in your own mind as to why you're going into it, and to make sure that pricing structure has the potential to work for both parties throughout the lifetime of the contract. The other point I'll make, going back to understanding exactly why you're going into this, you're pursuing this strategy, is there will probably be what you might term a winner from the arrangement. Someone's probably going to come out of it feeling that they've got the better end of the deal. And that's absolutely fine, because you've got to remember why you've gone into it, to de-risk your forward position. And that is something which I think is very much worth, in the current highly volatile day ahead gas market. I think that is something that really has to be borne in mind. Slide, please, Liz. I'll talk very, very briefly now about the potential sort of fly in the ointment for that gas plus certificates model, which is the European green gas certificate market. And this really does touch on what Helena was talking about. But the first thing I'll say about this graph, this chart, is all this is the green gas deals that I've done over the last 5 years or so. There's no science, there's no rhyme or reason to it. It's merely to share with those who are on this webinar, to show the trajectory of those waste and product certificates. It's very much not the gospel. This is the market. This is what you could have had, or this is what you should have had, or there will be people out there who've sold gas certificates for considerably higher prices than those. I'm quite sure of it. As you can see, there is there has been a continuous upward trajectory from 2017 onwards on green gas certificate prices. Broadly, the amount of green gas coming on is not keeping up with demand, hence the price is continuing to rise. Although, as Helen has noted, there's potential major upheaval in this market, which will reduce the which could well reduce the desirability of green gas certificates. I think it's just worth touching on what the drivers are have historically been within this market, and this is all retrospective, looking backwards, so not necessarily that useful, but I think it's worth bearing in mind. The price traditionally was always set by the Danish market, by Danish green gas certificates from the Danish pig industry, essentially using pig manure in AD plants to produce very circular economy, and those gas certificates always traditionally commanded the top prices. However, I think it's really worth bearing in mind in terms of those potential future negative drivers is that there's also likely to be a significant influx of French certificates coming into that European market as they start to be able to, as the French registry starts to become more compatible with the German Dana registry, which is kind of the main sort of settlement, the main market for green gas certificates within Europe. And fundamentally, most of those green gas certificates currently are going to Germany, or they're going to Switzerland, where they have, but again, in Switzerland, they have very precise requirements as to what they want from their green gas certificates. They want it to come from waste. They'd like it to have ISCC additional accreditations, and or the sort of the nature made accreditations. And I think the other point I'd like to make about that is it remains quite an immature market, where currently you predominantly do better by selling spot certificates that you actually have in the bank, as opposed to agreeing forward deals. We've agreed forward deals in the past. We continue to agree forward deals as part of our risk management strategy, but historically, they've always turned out to be not as good in the grand scheme of things as just holding on to them and selling them at a later date. And if you look at the graph, I just bring out those two dots that are hovering up there in 2022. You've got the waste ISCC certificates, which rumour has it potentially can trade at over £30 a meg. Again, I've not got any ISCC accredited plant, so I can't confirm or deny that. But also talk that unsubsidised gas with carbon capture, there's potential market for that. As I've got it in there at £40, but there's rumours that people are willing to pay up to £60 a meg for that unsubsidised gas. And that, when you think about use of gas for production of hydrogen, for production of road transport fuel, etc., suddenly becomes quite interesting as a potential future revenue stream, and it is will be quite a competitor for that sort of gas plus certificates deal, which you can potentially use to balance off your risk profile with your gas production. Next slide, please, Liz.
That's the last one we've got, Ewan.
Is it? Okay. Yeah. Well, the last one was literally just my contact details, and just to say thank you very much for the opportunity to speak to you all. As I say, if I was going to summarize here, I really stress the point about understanding what your risk profile is between your operational risk and that market risk. So we've got extreme volatility in the market, but at the same time, and as I say, just as an anecdote, twice over the last 5 years, we've have assets that have been knocked out of either the power or the gas grid for significant periods of time for reasons that were nothing to do with the plant. They were all to do with the distribution network, the relevant distribution networks. And when that happens, you really are quite exposed to these factors if you've got a forward sold position, and it's something that you really need to have a plan for. And I have to say, broadly speaking, we've managed to come through those okay, but if you're going to embark on one of these strategies, which in the increasingly volatile market, there's a lot of reasons to do it, you just really be aware of how that risk profile sits within your individual businesses.
Cool, thank you. So that's the end of all our presentations at the moment. So I kind of just wanted to say, thanks for your time. Thanks for joining us. Huge thanks to sort of Dave, Helena, Magnus, and Ewan for giving us the details and the information behind it. Thanks to Adbert for hosting this. I think the next stage is hopefully there's going to be a few questions from people around the different sort of presentations that we put together. So we'll just give a couple of minutes for people to sort of list the questions, and then we've got myself as well as the speakers, you know, we're to answer any questions that do get raised.
Looks like there's a couple of questions coming in around contact details for both Ewan and Optimised. This presentation will be shared, as will the recording, along with those contact details as well. So
yeah, we will share it along with individual contact details. So if you do have any further questions, which you'd rather do offline, you know, you can contact us direct. That won't be a problem. Looks like all the questions are basically around contact details.
If anyone does want to get in contact with me, just talk to Lewis, and he will pass on the relevant bits and bobs.
Lewis, there is a question. Is the UK looking to abandon the colours of H2 and go strictly to a carbon intensity rating?
I think probably one for Magnus. One of my comments at this moment in time is I don't really know what the UK is looking to do at this juncture. Maybe there's been a bit more security a couple of months ago, but I think with everything that's going on at the moment, there seems to be a lot of uncertainty in general just around hydrogen, green gas, green electricity, market prices. I don't know if you've got any further insights, Magnus.
I would say it would make sense to go to the carbon intensity measure, and I do think that is when I talked about then looking at the standards set and the production of hydrogen. The impression is that is the train of thought that BEIS are having on this. Quite when that will happen and when they will be put out, I'm not too sure though.
Cool. So we've got another question come through in regards to GHG protocol. So when we're basically, do we have a feel for when the industry feedback will be strong enough to change the guidance on Scope 1 market accounting? I mean, there's ongoing consultation with the World Research Institute. You know, we are part of a group with World Biogas Association in these discussions, sort of raising our concerns and kind of promoting the benefits of green gas because it is essential. And without this sort of clear guidance on Scope 1, it leaves people in limbo and could reduce potential revenue streams in the future. Personally, I've kind of been on an emotional roller coaster with the feedback that we get from WRI. Some have been, I'd say, going from a positive outlook where they may be putting a kind of a timestamp, so a limited period where you could basically quote Scope 1 emissions using green gas certificates, to maybe not so much. And I think they're just trying to clarify around themselves around this market-based, as Helena were touching on. It's about this market-based methodology and this buzzword of additionality at the moment. So we should know more in 2023 when the next release comes out. In which case, you know, we'll ourselves, along with likes of ADBER, etc., we'll communicate what comes out of that. We got any others?
Yes, Sean Gleeson has asked, would the CI be based on a CA model? And what about the CO2 sequestering from AD plants in addition to the CH4?
I mean, CO2 sequestering, you know, that is very much in the future plans. I don't know if you want to touch on one of your plants which does the carbon capture. Yeah,
it's an interesting one. So the So we have an AD plant which captures CO2 and uses it, and it gets turned into dry ice. So short chain carbon that was in the atmosphere last year, as opposed to millions of years ago. That doesn't count clearly as sequestration. It gets released, but at the same time, that's got a value, and it's got a value to someone else. I think increasingly going forward, being paid to sequester carbon dioxide will become a major revenue line for extant AD plants. And I think if you're trying to, not that something that I'm trying to do, but various members of the team that I work for, they look at the value of these assets over the 10-year, 15-year, 20-year period, and that's actually where a lot of the value of this could well lie in future, is with that sequestered CO2. I think it is very, very tricky. It's because a major part of it is proving on an ongoing basis that CO2 has remained sequestered. But there are projects in the works for this to happen, including one of our notable competitors. They are quite a long way along the road with this. So it's definitely something which the AD industry, I think, it's where we're going to be, probably sooner rather than later, actually.
Cool.
Another question from Marta. Do you foresee different contracted prices, stroke duration terms for offtake of green gas for heat and transport, considering the different subsidy schemes from the UK government?
I'd say definitely. I think when, if I look at, say, these corporate offtake solutions, power, we're looking at long-term 10-year contracts. Gas, we're looking at much shorter-term contracts. And I think potentially with the volatility in the gas market is going to make probably more of a leaning towards a shorter-term contract. I think that's effectively, yes, I do foresee there being some variations, but I think if you're looking 1 to 3 years in terms of duration terms, you're probably not going to be too far off. I don't think people will be looking for much longer, particularly with, when you mention this word again, uncertainty. There is a lot of uncertainty.
And a final question from John. Are there any long-term capital funding partners in the green gas sector that are non-VC in the short haul? There's a few more questions that have popped up.
That's probably one we could take offline, John, if that's okay with yourself. I don't think the investment is necessarily as much there, and I do think it is predominantly VC driven. But we can catch up offline if that's okay.
Okay, Peter Murphy asked how do we much more food to convert to biogas in the UK?
You want me to take this one, Liz?
I'm going to say that one for you, Ewan.
Okay, so food waste. Only 80 councils in England collect food waste, I think, is the figure off the top of my head. Out of I don't know how many there are, but I think it's a couple hundred. Food waste collection is relatively tricky, relatively difficult, relatively expensive. It is really tied up. I think the major issue here is local authority budgets are really, really squeezed, which means people who are not doing it already probably are not about to start doing it and roll out the infrastructure to do it. Should we be doing it across the piece? Absolutely, we should. In Wales, they have the highest rates of recycling in Europe, possibly globally, depending on how you want to look at it. And the reason why is because the Welsh government, for a period of about 10 years, has absolutely prioritised this. And consequently, every single bit of domestic food waste in Wales pretty much gets collected and goes into an AD plant. As I say, it's probably about 80 councils in the UK which does that. On the flip side of the coin is the commercial and industrial food waste. So that's what comes out of hospitals, food depackaging plants, supermarkets, all of that sort of stuff. The key thing to note here is and restaurants, is that the levels of that food waste have not returned to pre-pandemic normal to where they were pre-pandemic yet. So the market for food soup, as it's called in this country, remains an extremely aggressive one, with fueled to a degree, to be honest, by the high gas price, because if you can afford to pay for it, then you'll pay for it. But those food waste arisings have not returned, and that considering that when you build a new AD plant, you need to interface. I'm probably preaching to the choir here, but you need to interface where you can get a grid injection point, where you can get feedstock, where you can get a planning and permitting to treat that potentially, or to have that relatively unpleasant feedstock being dealt with and what have you. And to get all of those things is quite tricky. So I think it's a really difficult question, or it's an easy question with a complicated answer, I think is probably what I would say.
Just thinking with time at this moment, potentially we'll look to sign off now. If you do have any further questions for any of the speakers, myself, you, and etc., we will share the contact details. So please get in touch. Please engage with us. We're happy to return that. And hopefully you've all found this really useful. And thank you very much for your time, everyone.
Thank you.
Cheers, everyone. Bye bye.
Cheers.